Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Financial instruments and their risks. Financial instruments are fundamental components of financial markets, serving as the building blocks for investment, financing, and risk management activities. These instruments can be broadly classified into equity securities, debt securities, derivatives, and hybrid instruments. Each category carries distinct characteristics and associated risks, which are crucial for financial professionals, including associate professional risk managers, to understand and manage effectively. Equity securities represent ownership in a corporation and include common stocks and preferred stocks. Common stocks give shareholders voting rights and the potential for capital appreciation and dividends. However, they come with significant risks, particularly market risk and company-specific risk. Market risk, or systematic risk, refers to the potential for investors to experience losses due to factors that affect the overall financial markets, such as economic downturns or geopolitical events. Company-specific risk, or unsystematic risk, pertains to the potential for losses due to issues unique to a particular company, such as poor management decisions or product recalls. According to a study by Campbell, Littau, Malkiel, and Shu, the volatility of individual stocks is substantially higher than the market as a whole, highlighting the importance of diversification in mitigating company-specific risk. Preferred stocks, on the other hand, typically do not offer voting rights but provide a fixed dividend and have priority over common stocks in the event of liquidation. While preferred stocks are less risky than common stocks, they still carry interest rate risk and credit risk. Interest rate risk arises from the inverse relationship between interest rates and the value of fixed income securities, including preferred stocks. When interest rates rise, the value of preferred stocks tends to fall and vice versa. Credit risk, also known as default risk, is the risk that the issuing company may be unable to meet its financial obligations, leading to a loss for the investor. Debt securities, such as bonds, represent loans made by investors to borrowers, typically corporations or governments. Bonds are generally considered less risky than stocks, but still come with various risks, including interest rate risk, credit risk, and inflation risk. Interest rate risk affects bond prices inversely. When interest rates rise, bond prices fall, and when interest rates fall, bond prices rise. This relationship is quantified by the bond's duration, which measures the sensitivity of the bond's price to changes in interest rates. Credit risk in bonds is the risk that the issuer will default on interest or principal payments. This risk is often assessed through credit ratings provided by agencies such as Standard & Poor's, Moody's, and Fitch. For example, during the 2008 financial crisis, the default rates on corporate bonds soared, leading to significant losses for bondholders. Inflation risk, also known as purchasing power risk, is the risk that the returns on bonds will be eroded by inflation, reducing the real value of the bond's interest payments and principal. Derivatives are financial instruments whose value is derived from the value of an underlying asset, such as stocks, bonds, commodities, or currencies. Common types of derivatives include options, futures, forwards, and swaps. Derivatives are often used for hedging purposes, allowing investors to manage risk by taking positions that offset potential losses in their underlying investments. However, derivatives also carry significant risks, including leverage risk, counterparty risk, and liquidity risk. Leverage risk arises because derivatives often allow investors to control large positions with relatively small amounts of capital, magnifying both potential gains and losses. Counterparty risk is the risk that the other party in a derivative contract will default on its obligations, as was the case during the collapse of Lehman Brothers in 2008, which had extensive derivative positions. Liquidity risk refers to the risk that an investor may not be able to buy or sell a derivative at a fair price due to a lack of market participants. Hybrid instruments combine characteristics of both equity and debt securities or other financial instruments. Examples include convertible bonds, which can be converted into a predetermined number of the issuing company's shares, and preferred stocks with embedded options. The risks associated with hybrid instruments are a combination of the risks inherent in their underlying components. For instance, convertible bonds carry both the credit risk of the issuing company and the market risk associated with the potential conversion to equity. Additionally, the embedded options in hybrid instruments introduce complexity and valuation challenges, as their value is influenced by multiple factors, including the volatility of the underlying asset and interest rates. Understanding and managing the risks associated with financial instruments is critical for financial professionals. Risk management involves identifying, assessing, and prioritizing risks, followed by implementing strategies to mitigate or transfer those risks. Diversification, hedging, and the use of financial models and analytics are common risk management techniques. Diversification involves spreading investments across various assets to reduce exposure to any single asset's risk. Hedging uses derivatives to offset potential losses in other investments. Financial models and analytics, such as value at risk and stress testing, help quantify and manage risk exposures. In summary, financial instruments are diverse and complex, each carrying specific risks that must be understood and managed effectively. Equity securities come with market and company-specific risks, while debt securities are subject to interest rate, credit, and inflation risks. Derivatives introduce leverage, counterparty, and liquidity risks, and hybrid instruments combine the risks of their underlying components. Effective risk management is essential for mitigating these risks and ensuring the stability and profitability of financial markets. By comprehensively understanding the characteristics and risks of financial instruments, financial professionals, including associate professional risk managers, can make informed decisions and contribute to the overall health of the financial system. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UXL, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.